Hello, friends. Braden here, Tuesday, April 12th. Just wanted to do a real quick um, video to address hedging for a few people that have been asking. I've been getting a lot of tremendous feedback, and I've got videos coming your way on not only some fantastic options strategies and ways to really use options to your advantage and to use them really almost more so as an insurance policy than anything, but also hedging in general and just different practices and different methods to really protect yourself, put mechanisms in place literally and fail safe so that when we get ourselves into a September 2008 scenario or a summer 2011 scenario or the beginning of this year scenario where the indexes just absolutely fell off a cliff, you're protected by way of a put on the index. So in other words, you're simply going short by way of going long. So you're buying puts. The put is a contract against the index essentially. And again, this is not a bet here. You're not hoping this thing pays out. What you're doing is you're purchasing this as insurance, and that percent of your portfolio even is something that should be very seriously considered. Is it 1%, 5%, 10? Things that all really, that depends on your age, your time horizon, that depends on your goals, your risk tolerance, your capital, your allocated capital, how it's allocated. So a whole host of things. So you get a day like today. As I said, it's April 12th. Dow closes up triple digits. Energy Financials lead as oil surges. All the indexes are up. Everybody's happy. CNBC is happy as can be. Here in Canada, same thing. Markets are up. Loonie source to levels not seen in months as oil, of course, pushed it higher. And up across the board. And then, all of our stocks are up. It's been absolutely fantastic in Canada. We've had a pretty great 2016 actually overall, and that's not what concerns me in the least. All I'm simply wanted to say here, just because there was something I saw reason why I wanted to make the video today was this here. So I'll get to that in just 2 minutes. But essentially here I'll show you an instrument I've been using for many years. It's the S&P 500 ETF, SPY. There's many out there. There's leveraged ones, there's bears, there's bulls. Stay away from stuff you don't know. This one follows tick for tick and point for point. So in other words, it goes up 1.9%. The index is up that same and vice versa. We're looking at a daily chart. Each candle here representing one day. The red ones were down days. The white, of course, being days that closed up. Just had a big volume, nice up day. Although we did have a few anomalies. I just want to point out because I had a very nice trade on silver. There it is at 15 bucks. So we've got a few anomalies taking place, whereas we used to have an opposite correlation on an index and a metal like that, especially a safe haven metal, whereas we saw the opposite today. So there could be some great enthusiasm. We could see a nice drive into the 210 range here going into May, June, beyond. But when we go to the weekly picture now, so each candle was a day there. Now the weekly changes things here quite a bit. We had quite a bit of strength going into the summer. We fell off a cliff in August, September, October, came back into the end of the year, and then kaboom, we had a huge fallout, and these are serious swings, serious volatility. I mean, 207 kind of range, 210, let's call it, down to 180. That's a big swing for the S&P, the 500 biggest companies listed on the New York Stock Exchange. So very massive swing. We're at a sort of a triple top, could call it almost a head and shoulders. Again, I doubt this thing's going sideways. I don't think we're 205 in May. I think we're considerably higher or lower. And frankly, nobody knows, obviously, which one it'll be. I just know it's not going to be flat from here. Let's put it that way. The monthly is why I say that. RSIs don't really need to be watching. It's been very strong, the relative strength. But the MACD is obviously concerning a long-term trend of selling pressure essentially being propped up somehow. And then, of course, dwindling buying volume over the last 2 months. So what we're looking at with each bar here being an entire month. And again, 205.92 just being the closing price of the SPY. And again, just to clarify, that being the S&P 500. So as it tracks that index price, you can watch it through an ETF, SPY if you're on the American side. I'll get into all the details about sort of percentages and how I do it. But that is basically it. I will identify an opportunity like a very tired, overbought, about to roll over. If you can see a nice sort of healthy incline, a break, healthy incline and a break, smaller incline and no break. So it tried it 3 times. History has taught me personally that the next try will potentially even test down into the, dare to say, the 170s, because that is where the 50-day moving average is, if you look right here. But that is a potential level. So what I'm going to be doing right now, I'm doing good on long positions. I'm completely long. I'm all equities. I'm all long. I'm not in bonds. I'm not in cash. I'm not short anything. So because I'm long everything, and I'm not about to change that, what I'm going to do is I'm going to simply buy puts, buy a bet that this thing's about to fall over into May. And I'm going to buy time because, and this will come in another video, but these chocolate covered almonds, you've got equity in the middle and you've got chocolate melting every day. So when you buy at the end of April, you don't have a lot of time, and that daily erosion of value is sometimes quicker than the stock can move. It's, well, more times quicker than the stock can move. So in this particular case, I'd be buying at least May, the monthly May, if not September, but that depends on the premiums. So how do you find that out? SPY option chain. I personally like, there's a number of sites I use. NASDAQ is the easiest if you're new to it, because you can literally pick just to see your puts, just the in the money puts, just the monthlies. I want to see the Mays, of course. And as this slowly loads, what it does is it brings up for you all of your in the money. So again, you've got a strike price here of 206 would be where we start out in the money, 205 at the money, 204 below, etc., etc., etc. So I would start out in around this range. You want to make sure you've got a decent beta, which we'll again talk about later. And just decide, is it, again, 10%? Is it 5%? Do I just need to step in and sort of ladder my buys? Because again, you really want to, if you're buying 30 contracts, do not buy 30. Buy 10, buy 15. Just break it up. Make sure you're rather than buying and selling, think of it more as accumulating and distributing, if that makes sense. So hopefully that helped you guys. Any questions, I'm glad to answer. But again, this is sort of hedging 101 when you see a very oversold index, and you can use it as a tool to maintain those long positions, which, by the way, don't be afraid, obviously, to trim winners. But when I see an index that's come up that hard and flattened out and gotten real tired, I tend to think it's going to come down. So we'll see what happens. Hopefully she stays up, and we will talk to you guys very soon.